guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe. If rise and hold sounds like a poker strategy that may in fact sum up the all-in approach to fighting inflation that Federal Reserve Chair Jerome Powell is expected to lay out in a highly anticipated speech to the Jackson Hole Central Banking Conference on Friday. As debate raged in recent weeks about whether the U.S. economy was bordering on recession and how that might throw the Fed off its march to higher interest rates. Powell's colleagues leaned hard on the idea that the U.S. central bank's benchmark overnight interest rate would not just keep rising but remain at a high level until inflation returned for the Fed's 2% target. By the Fed's preferred measure, inflation is currently about triple that. I'm really going to try to best a result as possible. Once we get to a level that I think is the appropriate level to really stay there and to purposefully analyze and assess how our policies are flowing through the economy. Atlanta Fed President Raphael Bostic told the Wall Street Journal this week. Some weakening is to be expected in the economy, he continued, and it's going to be really important that we resist the temptation to be too reactionary and well make sure that we get inflation well on its way to 2% before we take any steps to increase accommodation in our policy stance. Don't expect the Fed to rescue the economy of or the unemployed from a modest downturn. The comments from Bostic and other Fed officials mark a subtle but important shift in emphasis in how the central bank talks about what it is doing. One Powell may well emphasize when he takes the podium at a mountain resort lodge outside Jackson, Wyoming at 10 a.m. In recent weeks, Fed officials have shifted from avoiding the R word, saying their hope was to avoid a recession, to downplay the significance of one, particularly in the context of the worst outbreak of inflation in 50 years. Controlling the growth in price pressures remains their prime focus. I don't see the risk of a sustained or depreciation to be very high, Philadelphia Fed President Patrick Harker said in an interview with CNBC on Thursday. The language matched expectation coming out of the United Kingdom and other parts of Europe that central banks may need to continue raising interest rates even in the face of a downturn rather than provide help in the form of lower borrowing costs and will boost the economy and employment. As much as central bankers have tried to avoid a trade-off between inflation and jobs, a sacrifice, a sacrifice that they feel they wrongly made in recent low inflation years out of a misplaced fear of rising price. They acknowledge they may have no choice in the current environment. The pain of a modest recession would be severe for those who lost their jobs. The cost of runaway inflation, in the Fed's view, would be much higher and come with even worse risks for the future. The tax now is to sell that view to the public. The labor market is very tight. I suspect to get some loosening in the labor market, you will see higher unemployment as the Fed cools the economy. Kansas City Fed President Esther Gorge told CNBC on Thursday. The Fed's target lending rate currently set in a range of between 2.25 and 2.50% may need to rise above 4.44%. Gorge said, "We will have to hold for some time as inflation falls. There is no guarantee how long that may take or what costs may be required in terms of lost jobs and output. The outcome back then was bad, along and scary recession followed by a banking system collapse, and with a painfully slow recovery in its wake. Okay, that's all from me. Thank you for watching. Don't forget to like, share, comment, and subscribe. Thank you.